Japan is witnessing an unprecedented financial shock. The 10-year government bond yield has surged past 1.7%, a level not seen in decades. This dramatic spike is being called a financial nuclear explosion, sending shockwaves through global markets. Is this the spark that ignites a new era of currency wars in 2025? Investors, policymakers, and central banks are all on edge, watching every move. Who will blink first in this high-stakes game? Will it be the Bank of Japan, foreign investors, or perhaps another central bank forced to respond? The world is holding its breath as the balance of power in global finance hangs in the balance. Over the past 30 years, Japan has quietly played a pivotal role in the global financial system. As the world's silent money printer, Japan's ultra-loose monetary policy flooded markets with cheap capital, making the yen a preferred funding currency for carry trades. Investors borrowed yen at near-zero interest rates, then poured these funds into higher-yielding assets abroad, fueling a cycle of risk-taking and liquidity. But what happens when the tide turns? As global yields rise, especially in the United States, the safety net that Japan provided begins to unravel. Investors rush to unwind their yen carry trades, triggering a mass exodus from U.S. bonds. Is this the first domino in a larger financial reset, or just a temporary shock? The answers may reshape how we understand risk and stability in today's interconnected markets. In just a few weeks, the Japanese yen has fallen to a record low, while the U.S. dollar has been continuously volatile, causing the entire global financial market to shake. What is really happening behind these numbers? As major central banks are forced to hold emergency meetings, is this a sign of a domino effect spreading across economies? Liquidity in the market is increasingly drying up, and cash flow is becoming scarcer than ever. Are we witnessing a silent tightening of money that could shake all investment strategies? Who will benefit, and who will be the victims in this fierce game? In recent weeks, major financial institutions have moved swiftly to lock in profits, withdraw capital, and adjust their investment positions. This wave of action is not just speculation. Real data tells the story. According to the latest reports, foreign investors have sold off billions of dollars in U.S. Treasury bonds, marking one of the largest capital outflows in recent years. Why are the so-called smart money players exiting what was once considered the safest asset? Is this a sign of deeper instability or simply a strategic repositioning? The sudden reversal in capital flows underscores how quickly market sentiment can shift, leaving many to wonder, what do these moves signal for the broader financial landscape? Many analysts argue that the root cause of recent market turmoil goes far beyond just rising interest rates. The real issue, they say, is a global liquidity crunch, an environment where cash and credit are drying up across borders. But why is this happening now, and who holds the reins? All eyes turn to the United States, whose monetary policy decisions ripple through every corner of the financial world. When the U.S. tightens liquidity, emerging markets feel the squeeze first, but eventually, even major economies cannot escape the shockwaves. Is it fair to say that the fate of the global financial system rests in the hands of a single nation? Or are we witnessing the inevitable consequences of years of easy money now coming to an end? Recently, the reverse repo market in the United States has shown clear signs of exhaustion. Major banks, once flush with liquidity, are now turning to the Federal Reserve's standing repo facility as a lifeline. What does it mean when financial giants must rely on emergency measures just to maintain daily operations? This shift signals that the system is no longer operating on its own strength, but is instead surviving on backup oxygen. Are we witnessing a temporary adjustment, or is this a warning sign of deeper instability? The reliance on these facilities raises urgent questions about the true health of the financial sector. What happens if the Federal Reserve refuses to inject more liquidity into the market? Suddenly, speculative positions are forced to unwind, triggering a wave of panic selling. We witness a paradox. Low-quality assets surge in price, while high-quality investments lose value. Is this not a classic sign of a liquidity squeeze on the brink of crisis? The financial system becomes a battlefield, where even the strongest players are not immune to shockwaves. Are we truly prepared for the consequences if the Fed stands firm and keeps the money taps closed? A new currency war is erupting on the global stage. Japan, once a steadfast buyer of U.S. debt, is now quietly reducing its holdings, while China has begun offloading U.S. Treasury bonds at an unprecedented pace. In the midst of this, the Federal Reserve finds itself trapped in a dilemma. Should it tighten policy to defend the dollar or ease up to support the economy? The once unchallenged dominance of the U.S. dollar is suddenly under threat. What happens when the pillars of global finance start to shift? Who will emerge victorious in this high-stakes battle for monetary supremacy? The world is watching, and the consequences could be seismic. Gold and silver have long been recognized as crucial indicators during periods of tightening liquidity. When cash becomes scarce and financial systems are under strain, sharp movements in gold and silver prices often signal underlying instability. Why do these metals surge just as markets begin to panic? A dramatic rise in gold in particular is rarely a sign of prosperity. It frequently foreshadows conflict, uncertainty, or even the onset of financial chaos. Are investors rushing to safety, or are they bracing for something far more severe? When gold prices spike, history warns us that the world may be on the brink of war or a major financial upheaval. Can we afford to ignore these warning signs, or is it time to reconsider our strategies before the storm hits? Geopolitical tensions between China and the United States have escalated, particularly surrounding the issue of Taiwan. Recent signals suggest preparations for possible conflict, raising concerns about the stability of the region. If these tensions continue to intensify, could we be facing a disruption of the global order that has existed since 1945? Investors and analysts are closely watching every move, knowing that even a small shift in diplomatic language or military posture could trigger dramatic market reactions. Are we witnessing the beginning of a new era, or will cooler heads prevail? The uncertainty is palpable, and the stakes have rarely been higher. A new risk is emerging in the United States. The labor market is weakening, not because of high interest rates, but due to the rapid rise of AI and automation. Unemployment rates are climbing, yet the root cause isn't traditional economic cycles. It's a fundamental shift in how jobs are created and lost. Are we witnessing the beginning of a structural transformation where machines and algorithms replace roles once thought secure? Major industries are forced to adapt, and workers face uncertainty about their future. How will policymakers respond when conventional tools like adjusting interest rates no longer address the core problem? The question remains, is this the dawn of a more efficient economy, or the start of a prolonged employment crisis? Recently, the Federal Reserve has shifted to a noticeably softer tone in its communications. Key officials have subtly hinted at the possibility of adjusting monetary policy, fueling speculation throughout the financial markets. As a result, the probability of an interest rate cut in December has surged dramatically. Is this a signal that the Fed is responding to mounting economic pressures, or simply a strategic move to calm market nerves? Investors and analysts alike are now recalibrating their expectations, weighing the potential impact of a policy change on asset prices and economic stability. In moments like these, even a slight change in messaging can trigger significant volatility, leaving everyone to wonder, what will the Fed's next move mean for the global financial landscape? Imagine a scenario where interest rates are suddenly slashed, but liquidity in the market is already drying up. At the same time, major investors from Japan are pulling their capital, while the U.S. government faces an urgent need to borrow even more. Add to this the labor market, now under increasing pressure, as artificial intelligence replaces jobs at an unprecedented pace. Are we truly laying the groundwork for sustainable growth, or are we simply inflating a new bubble, waiting to burst? With so many risk factors converging, can a rate cut really solve the underlying problems, or does it just postpone the inevitable reckoning? The stakes have never been higher, and every decision could tip the balance. The market is witnessing a dramatic divergence. While major technology stocks continue their upward surge, small and medium-sized businesses are struggling to survive, squeezed by rising costs and limited access to capital. In the real estate sector, home prices in the United States have reached unprecedented levels, pushing the dream of ownership further out of reach for many. Now, the idea of a 50-year mortgage is emerging, stretching debt obligations beyond the average human lifespan. Is this a sign of innovation or a warning of unsustainable risk? What does it mean when only a handful of giants thrive, while the broader economy faces mounting pressure? The gap between winners and losers has never been more stark. Across the globe, BRICS nations and India are making headlines with record-breaking gold purchases. What does this unprecedented demand for gold reveal? It signals a growing skepticism toward traditional paper currencies, as major economies begin to question the long-term stability of fiat money. The shift is clear. Capital is flowing out of the US dollar, challenging its dominance as the world's reserve currency. Are we witnessing the birth of a new financial order, where trust in tangible assets outweighs faith in central banks? This movement raises critical questions about the future of global finance and the strategies investors should consider in these uncertain times. In summary, Japan has laid the first stone for what could become the currency war of 2025. The Federal Reserve appears poised to ignite further volatility, setting the stage for a global financial system where every misstep carries amplified consequences. Are we witnessing the opening moves of a high-stakes game among the world's largest economies? Or is this simply another cycle of market turbulence? As the balance of power shifts, investors and policymakers alike must ask themselves, who will emerge unscathed and who will pay the price? In this new era, discipline and vigilance are more crucial than ever. Why is the Federal Reserve almost certain to cut interest rates in December, even knowing the risks involved? What is truly causing the labor market to cool so rapidly? Is it just a natural economic cycle, or are there deeper structural issues at play? And if the Fed does lower rates, will that be enough to revive the American economy, or will it simply prolong a painful downturn? Investors are left with tough questions. Should they trust in a policy shift, or prepare for more turbulence ahead? In moments like these, the line between strategic investing and reckless gambling becomes dangerously thin. The illusion of a robust economy can be dangerously deceptive. When inflation appears to be under control, but is actually masked by temporary factors, investors and policymakers alike may fall into the trap of phantom inflation. Similarly, a labor market that seems strong on paper, thanks to part-time jobs or statistical quirks, can create a false sense of security. This collective optimism, built on shaky foundations, puts the Federal Reserve in a precarious position. If the Fed cuts interest rates too soon, does it risk admitting that the recovery was never truly solid? Or if it waits too long, could it choke off genuine growth? The dilemma is clear. Act decisively and risk credibility, or hesitate and risk economic stagnation. In this high-stakes environment, every decision carries profound consequences. In recent weeks, 3 powerful shocks have struck the U.S. financial landscape, forcing the Federal Reserve into a corner. First, the American labor market, once a pillar of resilience, is cooling at an unprecedented pace, raising questions about the true strength of the economy. Second, banking system liquidity has plummeted to alarming levels, signaling growing stress beneath the surface. And third, the U.S. government is preparing to unleash yet another wave of debt, injecting trillions of dollars in new bonds into an already fragile market. How can the Fed ignore these simultaneous warnings? Are we witnessing the buildup to a systemic crisis, or will policymakers find a way to restore confidence before it's too late? The American labor market is facing unprecedented challenges. Unemployment rates are rising, not just because of economic cycles, but due to the relentless advance of automation and artificial intelligence. Most new jobs created today are temporary or part-time, offering little long-term security. As AI systems increasingly replace white-collar workers, a growing segment of the workforce finds itself displaced with skills that no longer match market demands. This is structural unemployment, a deep-rooted issue that cannot be solved simply by adjusting interest rates or monetary policy. Can traditional economic tools truly address these seismic shifts, or are we witnessing a fundamental transformation of the job market? The answers remain uncertain, leaving both workers and policymakers searching for new solutions. The recent jobs report may have sparked optimism for many, but do those rosy numbers truly reflect the real state of the U.S. labor market? Beneath the glossy surface lie clear signs of rot. Hidden unemployment is quietly rising, the number of high-quality jobs is steadily declining, and more people are being forced to settle for temporary or part-time work. The Fed can no longer pretend that the U.S. economy remains stable. Surface-level data is merely masking deep underlying cracks. Is the market being deceived by false signals? And who will pay the price when this shiny facade finally collapses? The current state of bank liquidity is raising serious concerns. With the reverse repo market nearly empty, banks are now forced to rely on the standing repo facility to meet their short-term funding needs. But why has liquidity dried up so dramatically? One major factor is the U.S. government's unprecedented borrowing, which is soaking up available cash in the financial system. At the same time, persistently high interest rates are discouraging new inflows, while foreign investors are pulling their capital out of the market. Is this just a temporary squeeze, or are we witnessing the early signs of a deeper financial strain? The answers remain uncertain, but the warning signals are hard to ignore. If the Federal Reserve decides not to lower interest rates, the risks could escalate rapidly. Liquidity tensions in the financial system may intensify, potentially triggering a chain reaction. Could this be the spark for a dramatic collapse in the bond market? Some experts warn that major banks, already under pressure, might not withstand another shock. Meanwhile, highly leveraged hedge funds could become the fuel for a financial firestorm. Are we on the brink of a crisis, or will the system find a way to adapt? The stakes have rarely been higher, and every decision now carries global consequences. The Federal Reserve stands at the heart of America's financial rescue efforts. As the government prepares to issue over $2 trillion in new bonds, a pressing question emerges. Who will buy them when investor appetite is fading? With fewer buyers stepping forward, the Fed faces mounting pressure to lower interest rates, hoping to make these bonds more attractive. But does this strategy truly solve the problem, or does it simply delay an inevitable reckoning? If rates fall, borrowing becomes cheaper, but inflation risks may rise. Is the Fed acting as a savior, or is it merely postponing deeper fiscal challenges? The answer remains uncertain, leaving markets on edge and observers questioning the long-term consequences. The Federal Reserve's role has never been more critical, or more perilous. No longer just the central bank for the financial system, the Fed now acts as the central bank for the entire U.S. government. What does this shift mean for the economy? By stepping in to finance persistent budget deficits, is the Fed enabling a dangerous cycle of government overspending? The line between supporting stability and fueling long-term fiscal risk has become alarmingly thin. If deficits continue unchecked, could the consequences spiral beyond control? These are questions that every investor and policymaker must confront in this new era of monetary power. Geopolitical risks are escalating as tensions between China and Taiwan reach new heights. The surge in defense production signals that major players are preparing for scenarios that once seemed unlikely. But can the United States truly sustain a large-scale confrontation if borrowing costs remain prohibitively high? This question hangs over global markets, fueling uncertainty and volatility. Every policy announcement, every shift in rhetoric can trigger dramatic swings in investor sentiment. Are we witnessing the build-up to a new era of global realignment, or will cooler heads prevail before the costs become unbearable? The world watches, uncertain which path will ultimately unfold. Few realize just how deeply interest rates affect America's defense budget. For every single percentage point increase in rates, the United States faces an additional $300 billion in annual interest payments. That's money that could otherwise bolster military readiness or fund new defense initiatives. In a world where geopolitical tensions are rising, can the U.S. afford to see its resources drained by mounting debt costs? Conversely, a reduction in interest rates would free up significant funds, offering much-needed flexibility as the risk of conflict escalates. Is it possible that the fate of global security hinges, in part, on the subtle shifts of monetary policy? A series of powerful forces are converging, putting immense pressure on the Federal Reserve to cut interest rates. The labor market is showing signs of weakness, raising concerns about rising unemployment. Liquidity in the financial system is drying up, while the government continues to inject massive amounts of debt into the economy. Foreign investors are pulling back from U.S. bonds, and geopolitical tensions are escalating, adding layers of uncertainty. Japan, once a major source of capital, is now withdrawing its investments, and the dominance of the U.S. dollar is increasingly under threat. On top of all this, the rapid rise of artificial intelligence is causing structural unemployment, reshaping the job market in unpredictable ways. In the face of these challenges, can the Fed afford to stand still, or is a rate cut now inevitable? No one truly wants the Federal Reserve to cut interest rates at this moment, not the markets, not the policymakers, and not even the Fed itself. Yet, is there really any other option left on the table? Lowering rates now feels less like a strategic choice and more like an unavoidable fate. Are we witnessing a scenario where economic pressures are so overwhelming that even the most reluctant actors are forced to act? What does it mean when a central bank is cornered by circumstances beyond its control? This is not just a policy shift. It's a signal that the usual tools may no longer be enough. In such a situation, who actually benefits, and who stands to lose the most? In the midst of unprecedented market volatility, every investor faces a critical question. Are you truly investing or merely gambling with your capital? When prices swing wildly and headlines fuel uncertainty, the line between calculated risk and reckless speculation becomes dangerously thin. How can you distinguish between a disciplined investment strategy and a bet driven by emotion or fear of missing out? The answer lies in risk management, setting clear plans, defining your limits for profit and loss, and maintaining unwavering discipline. True investors focus on long-term value and resilience, while speculators chase quick wins, often at great peril. So, which mindset guides your decisions in these turbulent times? In summary, the market is witnessing a fierce confrontation between major financial players and individual investors. On one side, institutional giants are withdrawing capital, signaling caution and triggering waves of uncertainty. On the other, small investors continue to buy the dip, driven by optimism and faith in long-term value. This is not just a battle of numbers. It's a clash between confidence and panic, between calculated retreats and bold advances. So, where do you stand in this currency war? Are you guided by conviction or swayed by fear? The choice is yours in this ever-shifting financial landscape. In the world of financial markets, staying alert, disciplined, and maintaining self-control are the keys to survival. Without a clear plan and emotional balance, even the most promising opportunities can quickly turn into costly mistakes. The market will always test your patience and conviction. So, are you prepared to act with reason instead of impulse? Remember, the difference between success and failure often lies in your ability to stay calm amid chaos. If you want to keep up with the latest updates on the Fed, Japan, and global capital flows, don't forget to like, subscribe, comment, and follow the channel.